Bitcoin is setting up for a 70% drop. We are not there yet, and price is expected to rally first, but that rally is the trap. And in this video, we are going to show you exactly how this plays out step by step, level by level, before it happens. A rally into the mid-90K region is wave B of an ABC correction. A rejection at that level, followed by a structural break of the $60,000 low, would confirm the final descent of wave C to our target of $28,500. A drop from the mid-90K region all the way down to $28,500 is a 70% collapse in Bitcoin price. In this Bitcoin technical analysis video, we map out every step of this move. The levels, the catalysts, the confirmation signals, all of it. This is the chart analysis every Bitcoin holder needs to watch before that rally comes. For those who follow us, here's the structure of our analysis. We work through 6 pillars: position, pattern, price, momentum, volume and volatility, and time, all sitting within an overarching macro outlook that incorporates correlated markets. You can see how we apply this in a practical way, and it ensures we take a balanced and objective view before placing a trade. Before we get into the bigger picture, let's be clear about where we stand right now. We see no immediate drop. In fact, we see the exact opposite. Bitcoin is strengthening, and right now we are in buy mode. But we are buying with our eyes wide open, because what comes after this rally is what this video is really about. And before anyone asks, we are long-term bullish on Bitcoin. We believe in Bitcoin as a store of value, inflation hedge, and asymmetric growth. But markets do not go up in a straight line. This corrective phase is not the end of the story. It is a necessary chapter. It is the market's way of shaking out weak hands, resetting sentiment, and creating the conditions that allow institutional buyers to step in at levels that make sense for them. The pain of wave C will lay the foundation for the next genuine bull cycle. But first, we have to get through it. The 2026 high was made on the 14th of January at $97,900. From there, price dropped sharply to a structural low of $60,000 on the 6th of February, a swift move that caught many by surprise. In our previous video, we explained that Bitcoin was working within an uptrend from that $60,000 low, butting its head against the 2026 yearly midpoint at $78,950, with buyers getting stronger, chipping away with each attempt to break higher. And since that video, we have seen exactly that push. Price has broken above $80,000. That $80,000 zone now becomes the springboard. Buyers began anticipating a low back at the start of April, and as that picture becomes clearer, more and more buyers are stepping in, pushing prices higher. The momentum is building, and the move into the mid-90K region looks increasingly likely. But this is exactly where it gets dangerous, because that rally is what smart money is counting on, to draw in fresh buyers at exactly the wrong time. The bull run feels back on, the bottom feels like it's in, but this is the bull trap, and when it snaps shut, it will leave those buyers high and dry, wondering what just happened. To understand why, we need to zoom out to the bigger picture. Looking at the yearly swing structure, Bitcoin is clearly in a higher time frame uptrend, but we are also in a corrective phase, and understanding that correction is the key to understanding everything that follows. From the all-time high of $125,761 on the 6th of October 2025, Bitcoin declined sharply to the structural low of $60,000 on the 6th of February 2026. That move is wave A of an ABC correction, and we are assuming, until the market tells us otherwise, that wave A is now complete. But what actually caused wave A, and why did it happen so fast? This was not a single event. It was a perfect storm of converging pressures that turned what looked like a healthy bull market into a 40% collapse in a matter of months. Institutions became heavy sellers. January 2026 alone saw over $1 billion in net outflows from spot Bitcoin ETFs. The floor became a trapdoor. Large holders who had accumulated near the $126,000 peak began to panic sell, accelerating the decline. The nomination of Kevin Warsh as Federal Reserve Chair signaled the end of the easy money environment that had fueled the bull run, and risk assets sold off immediately. Geopolitical tensions, a partial U.S. government shutdown, and over $2.5 billion in leveraged long liquidations in a single day created a cascade that pushed prices down faster than fundamentals alone could justify. Wave A was not one thing, it was everything at once, and that is what made it so damaging and so difficult to see coming. Now, current price action is playing out Wave B, the rally phase of the correction, and Wave B rallies are notoriously dangerous precisely because they feel so convincing. So what is actually driving this rally, and why are we suspicious of it? Bitcoin gained 12.7% in April, but when you look under the hood, the fuel driving this move is not the kind that sustains a genuine bull market. The first driver is short covering, traders who bet against Bitcoin being forced to buy back their positions as price rallied. That is not new demand. Once they're done covering, that buying pressure simply stops. The second driver is hope. Optimism around US-Iran negotiations and a potential Middle East ceasefire sparked risk-on sentiment, but hope is fragile. When hope fades, the positions built on it unwind just as quickly. The third driver is regulatory optimism around the Clarity Act, legislation that is still being debated, amended, and delayed. None of these drivers represent a fundamental shift. They are temporary and sentiment-driven, and they are exactly the conditions that smart money exploits to distribute into, selling into the excitement while retail buyers pile in believing the worst is over. This is why we believe Wave B is suspect. The price is moving higher, but the foundation beneath it is not as solid as it appears. That said, we do not fight the trend. If the market wants to go up, we flow with it, until the party stops. Now let's look at what our framework is telling us right now. In our previous video, we identified the Fibonacci resistance zone between $78,341 and $79,903. This is the level to watch. We expected it to be smashed through, and that is exactly what has happened. Price has broken above $80,000, and we now establish fresh zones for the move ahead. The new Fibonacci resistance zone sits between $92,273 and $93,579. This is the level we are targeting for the Wave B peak, the level where we expect buyers to push price into before the bull trap snaps shut. We are currently sitting at $80,460, so there is still meaningful upside ahead before we reach that level. Zooming into the daily swing structure, the picture continues to confirm the bullish case. We are producing a clear series of higher highs and higher lows. The 29th of April low is now acting as a key support level, and as long as buyers continue to defend it, the path higher remains intact. On Ichimoku, following the TK cross on the 12th of April, price has broken into open space above the cloud, blue skies ahead. There is no overhead cloud resistance to navigate. The path of least resistance is to the upside. As of today, the 4th of May 2026, if we close with a bullish engulfing candle, it is further confirmation that buyers are in full control. The right side of the market right now is as a buyer. But remember, in our view, this entire move is setting up for a bull trap. You now have a clear upside target between $92,273 and $93,579 to take profits should this play out as we anticipate. On volatility, the yearly close to high has broken above the 50% midpoint. May is following through from a strong April close, but yearly ranges have been declining since 2024. And with 2026 showing an early range of just $37,900, this is not the expansive volatility of a genuine bull market. Our proprietary momentum indicator gave us a buy alert nearly a month ago. We have been long since then and have no reason to take profit yet, with our anticipated upside target around $93,000. So what would actually cause Wave C, and why would it be so severe? Wave C is different from Wave A. Wave A catches people off guard. It's sudden and unexpected. But Wave C arrives when people are already committed. They bought the recovery. They told their friends the bottom was in. They are positioned long and fully invested. When Wave C hits, there is no orderly exit. There is panic. And panic selling accelerates the very decline it is trying to escape. The first catalyst we are watching is the Japanese government bond market. Japan has kept interest rates artificially low for decades, fueling one of the largest carry trades in global financial history. If the Bank of Japan announces a rate hike, investors are forced to sell global assets, convert back into yen, and repay their loans, essentially erasing capital from the global financial system. This triggers margin calls, a rush for cash, and liquidity evaporation across every market. The last time this carry trade showed signs of unwinding was August 2024, and Bitcoin dropped over 30% in days. A full unwind would be an entirely different magnitude of event. The second catalyst is the petrodollar. Growing signs suggest GCC nations may reduce their commitment to recycling oil revenues back into U.S. treasuries. If that flow slows or reverses, it puts significant pressure on the U.S. bond market and on the liquidity supporting risk asset prices.
Third is a broader U.S. Treasury sell-off. When the world's reserve asset comes under pressure, it triggers risk-off across every asset class. In a liquidity crisis, everything gets sold, and crypto gets sold hardest and fastest. We're already seeing early signs of this dynamic. When the bond market sneezes, the equity markets catch a cold. And there is a strong correlation between the Nasdaq, Bitcoin, and crypto because they are all technology-based. Watch the Nasdaq and S&P 500 charts for potential clues on where Bitcoin is heading next. And then there's the fourth catalyst, the one nobody can predict. The sharpest market moves are triggered by events that weren't on anyone's radar. We cannot name it, but the environment is fragile enough that it wouldn't take much. What we can tell you is that we are watching the 21st and 22nd of June as a potential turning point. Gann's seasonal dates have historically marked significant shifts in market direction, and that window aligns with where we would expect the Wave B rally to be exhausting itself. It is not a guarantee, but it is a date to have on your calendar. The ABC correction is not just a technical pattern, it needs a catalyst to complete it. Wave A had one. Wave B is being fueled by relief and hope. Wave C needs something bigger, a genuine liquidity event that removes the bid from the market entirely. The technical structure is already mapped. The macro environment is already building. All that is needed now is the trigger. Now, let's look at the bigger picture and explain exactly how we arrive at our $28,500 target. Most traders are focused on the next candle, the next day, the next week, but professionals step back, and when you do that with Bitcoin, the picture tells a very different story. Our analysis looks back 5 years. The price channel on this chart is derived from the 2020 COVID lows. That is the foundation, and everything since, every bull run, every crash, every recovery, has played out within the boundaries of that structure. The $28,500 target is not a guess. It has been precisely calculated from 3 of the most significant swing lows in Bitcoin's recent history. The 2020 COVID low at $3,717. The 2022 FTX crash low at $15,479, and the 2024 Japan carry trade unwind low at $49,351. 3 separate events, 3 generational lows. When you run Fibonacci analysis across all 3 turning points, they converge on a tight cluster between $27,818 and $29,835, just under $30,000. That is not a coincidence. That is the market leaving its fingerprints across time. We then add a 4th confirmation. Wave A and Wave C have equality in length, a core principle of ABC corrections. When we apply that principle here, the target aligns precisely with that same Fibonacci cluster. And the assumed Wave B high sits at our Fibonacci resistance zone between $92,279 and $93,579. A drop from that level to $28,500 is a 70% collapse in Bitcoin price. 4 independent measurements, 1 conclusion. $28,500 and the 70% collapse explanation we promised we would deliver on. And here is the important context. We are not saying Bitcoin is finished, far from it. This corrective phase is necessary. It is how markets reset. It is how weak hands get shaken out and how institutional buyers accumulate at the levels that make long-term sense for them. The pain of Wave C will create the foundation for Bitcoin's next genuine bull cycle, one built on real fundamentals rather than hope and short covering. But first, we have to get through it. This is why we are mapping this now, before the rally reaches its peak. Because by the time Wave C begins, it will feel like the bottom has already fallen out. It will be fast, it will be brutal, and the majority of market participants will not be prepared. We will be watching every step of this unfold. When the signals confirm that Wave B is complete and Wave C has begun, we will bring you that video immediately. Until then, stay on the right side of the market. Watch the rally unfold toward the mid-90K region. Take profits at the Fibonacci resistance zone between $92,279 and then watch very carefully for what comes next. Before you go, join our free daily crypto trading newsletter. It's just a 5-minute read, and it will keep you ahead of what's moving in the market. The link is above and in the description. If you found this analysis useful, subscribe to our channel Crypto Trading Mastery. We publish daily Bitcoin and crypto analysis, and hit the notification bell so you don't miss our next video. Thank you for watching. We'll see you next time. Take care.